Good day, everyone here. Chris Capre, founder of Second Skies. I want to say welcome to everyone here. Good to have you all here. How's everybody doing today? Howdy, Wolf. Howdy, FX Street. Yes, welcome back. Good to be back. It's nice to be back at Command Central here. So don't get me wrong, being on vacation is wonderful and everything, but trying to run the business and trade from the laptop is just not the same as being behind the HAL 9000 here. So good to be back. Fantastic. Hopefully you all had a good July 4th weekend. Hope you all enjoyed the fireworks and everything like that for those of you who do celebrate. And trading, how's trading been going for everybody? Anybody been doing any Ichimoku Cloud trading lately? I'm interested to see how people's trading has been going lately. Part of the reason why I'm interested was because yesterday there was a really good article on Bloomberg, and they were talking about how 54 of the largest currency funds tracked by Deutsche Bank, of the 54, only 32 this year are actually making money, and they're not making that much. And last year it was 51 out of the 54. So this year currency funds are having a hard time. In fact, the largest fund out there that I know of, FX Concepts, they manage about 13 billion in currencies. They're actually down 5% for the year. Yeah, one of the biggest hedge funds is in deep trouble. So they, 5% for them is not that big a deal, considering they made like 70% the year before. But it's still negative, and they're not used to that. So, if the biggest funds are having trouble, I'm interested to see how you guys are doing, basically. So, I'm curious as to how all your trading's been going. Some people are saying still trying to adapt. Yes, absolutely. That is definitely for sure. All right, fantastic. Great. Well, I want to welcome everyone here to the class. Before I begin, that's exactly, it's slow summer. Remember, though, July last year, at the end of July, 26th, 27th, is when the markets went crazy. If the Dow can't break, the 8,900 barrier, and if it starts to get a massive sell-off because the short-term bull run is over, we could see some serious increase in volatility in the currency soon. You adapted to scalping since September, okay? All right, fantastic. Well, we're recording this webinar. Just want to let y'all know. And today's class is focused upon the Ichimoku Cloud. This is the weather report here. Is there anybody here that's new for your first time? I have a feeling there's some new people here. Some of these names look very, very new. And if you are, I want to say welcome and good to have you here. If you are new, go ahead and just give me a show of hands. Fantastic. Bernie from the UK. Good to have you here from the UK. Frank is new. Gustavo is new. Derek is new. Great. We got a lot of new talent here today. Fantastic. All right, great. An engine as well. Good. Well, welcome. Okay, so for those of you new, this class is specifically focused upon the Ichimoku Cloud and trading the Ichimoku Cloud. It's a Japanese method that really is designed to do multiple things. It's designed to give you both static and dynamic levels of support and resistance. It's supposed to give you clear indications when you're in a bullish or bearish environment, whether you're in a trending environment or not. That's all what it's designed to do. And on top of it, it's designed to give you signals, which we all like. So with all that being said, let's talk about the Ichimoku Cloud. Let's talk about it in terms of what I want to go over today, how I've been using it lately, and how I'd recommend you guys using it, and how we can use it from here on out. Okay, so lately, if y'all noticed, markets have been a little bit choppy. If I step back out on the euro dollar to the daily chart, we can see this pretty clearly, that over the last, since basically just before June on, we have been in a pretty choppy environment. You can see it right here because we have a mix of bull and bear candles, or red and blue candles. Before, we were trending nicely. We were above the tanking line. Now we're dicing through all the lines completely. Tanking is the white line here. This blue is the 20 EMA. and that's for CBJ and Boykin. And then here, the red line is the Kijun. And before that, we were clearly above it or clearly below it, but it was relatively consistent. Now, it's just super choppy. It's dancing on both sides of the fence here. It's got double agents, so to say. And with all that being said, it's been, a couple days up, couple days down, couple days up, and you haven't been able to really grab a direction. So with that choppiness, with just using the general purview of the Ichimoku Cloud, I actually haven't been trading the 30-minute or 1-hour time frames, which is my normal intraday weapon for Ichimoku Cloud. Why? Well, I've kind of already highlighted that because the markets aren't moving consistently in one direction. They're just kind of chopping all over the place. You're going to fail to get any really good building moves or building trends, anything that, builds up some good momentum and steam behind it, order flow and consistency. Of all of the US dollar pairs, only one of them is in what we call a relative trending environment right now. Any guesses as to what pair that is? And I'm going to leave that question out to you. Anybody who reads my articles, now that I'm back, I start publishing articles. If you read my article last night, you would have gotten the answer to this. But any guesses as to what pair is trending right now, to some degree? It should be a pretty easy one because there's only one. Aussie dollar is not the answer, but it was a good guess. We're talking US dollar pair. So VMilch 35, yeah. Mike's saying euro pound. I'm going to go with just dollar-based pairs right now. Euro USD is not the answer. However, Mike, that is an acceptable answer, even though it's not what I was looking for. Dollar CAD is the answer. Forex champion, man, you have just been an absolute stud lately in terms of answering questions. Yeah, so right now, dollar CAD is the only dollar-based pair that's actually trending right now. And how do we know that? Well, just by using the Ichimoku Cloud, we can kind of detect that very easily. You can see how this is the only pair where the price action is consistently above or below one of the lines. And it has some distance from the 20 EMA. So not only is the 20 EMA angling upward, it has distance from it. When something has really good distance from it, that suggests that there's some volatility involved in that. And it's the same thing right here. I mean, we haven't had a close below the Tenkan line since the very early parts of June. So you're talking almost a month now. And it's been mostly bullish since then. We haven't had one close below the 20 EMA since also the same amount of time period. So since then, with all these lines turning upward, we are in kind of a short-term environment that is trending for the dollar. It's the only one that's really moving in one clear direction. So if I was going to use the Ichimoku Cloud on any particular pair, it would be in terms of 30-minute, 1-hour charts, which is my favorite intraday time to use Ichimoku charts, I would do it on the dollar CAD. In terms of all the other pairs, I wouldn't touch it. And it's very clear as to why. So you can see the pattern is very clear in terms of the Euro US dollar. The pattern is choppy. It's a choppy pattern right now. It's on all sides of the lines there. There's no consistency. Taking a look at pound US dollar, same thing. Take a look at that. The pattern was a little bit clearer that it was above the Tenkan and the 20 EMA for a while, but now we're below the 20 EMA for the first time. And to me, I actually think this is going to be a bearish signal. We'll be talking about this a little bit later. Moving on to dollar Swiss, just a mess all over the place. Aussie dollar, same thing. Violating it on all sides. Look to Kiwi dollar, again, same thing. A little bit clearer, showing a little bit more resilience, but now on the other side of the fence. And so those are all the dollar-based pairs that I have. So dollar CAD being the only one that is really trending right now. Therefore, that's the only one I'm applying the 30-minute, 1-hour weapon to, basically. Fat has a question, who do I use as my broker? I have a few brokers that I work with. I trade funds through Gain Capital. I also use FXCM, and Deutsche Bank FX is another preferred broker for me. So mostly because Deutsche Bank is an actual bank and they insure deposits, up to quite a large amount. So and they just have massive liquidity, so massive advantage of being with Deutsche Bank FX. Okay, so I've gone over the first point, which is really, or first and second points, which is really what I want to talk about today, which is if you like to trade Ichimoku, stay away from the 30-minute 1 hour for now. Until we get in a clear trending environment, we want to stay away from the 30-minute 1 hour Ichimoku charts. Why do we want to stay away from, for those of you that are new, why do we want to stay away from the 30-minute 1 hour charts in the Ichimoku? That's because the Ichimoku Cloud was designed to give you signals in trending environments. It's designed, whether it's short-term or long-term, that's what it is designed to do. So with that being the case, since there is no trending environments on the greater time frame, you're not going to find it on the smaller time frames as well. You may find these little small micro trends, but that's it. That's all you're going to find. And so because of that, the Ichimoku Cloud likes to filter out a lot of these false signals. It kind of takes a lot, or a little bit more than usual, for the Ichimoku Cloud to give you the signal. But when it does, it tries to do it in such a way that it's saying, hey, look, this is a high probability trade. Why? Because I've used a lot of filtering methods to determine whether this is a signal or not. And so with that being the case, that is why you're going to see a lot less signals on the intraday time frame, and that's okay. You don't want to try and dance salsa when everybody's dancing tango. You don't want to try and do the rumba when everybody's doing salsa. So the important thing is that we learn to dance with the environment giving us right now. And what the market is saying right now is, hey, choppy ranges on the daily charts, no clear trend. You can play wider ranges, or you can play the rejection plays, which is one of the things that I've been doing a lot, is playing rejection plays. And I want to talk about that a little bit later today. In fact, we're going to get into some examples. The first pair I really want to focus in on today is the pound US dollar. This is, again, going to consume some of my, a good portion of my time. If you all remember from last week, I was talking about the pound US dollar. What was I saying is going to likely happen with the pound US dollar? Did anybody remember that at all? Anybody? Who was here last week? Fall. Okay, exactly. And so if I am correct, last Tuesday was the 30th. So let's take a look at the 30th. Here's the 30th. The thing closed in a shooting star type fashion. I said the thing was going to fall. And look what happened since then. The thing closed just under 165, and here we are at 161.58. And so that's exactly what it's done. It's fallen since then. What is most interesting in terms of the price action in relationship to the 20 MA and the Kijun, or particularly the Ichimoku Cloud, remember the Kijun is an aspect of the Ichimoku Cloud, and that's this red line right here. Kijun Sun is translated generally to mean trend line. So that is kind of why it's the longer moving, sort of pseudo moving average. It's not a moving average, but it's like a moving average. So if we look at this here, take a look at how the pair has been behaving since this fake out here. Well, we've had one little doji here right at the Tenkan, and then we've had since then, I'm going to call this a down day. Assuming that today we end the day down. Assuming we end the day down, then we now have had 4 straight consecutive days of selling. And so since the massive reversal, we followed it up with 4 days of selling, but on top of it, we did something a little more interesting. Right around 162, this pair was a quintuple bottom. It had touched it actually 6 times. 1, 2, 3, 4, 5, 6. And all 6 times, it made it to the 164, 165 region. It was clear that it wasn't able to break the 162. In fact, the largest breach of the 162 handle was about 13 pips until we had this massive move here, and then look what happened here. So looking at this thing breached it by 105 pips. It did reject it, but then look at what happened since then. It was able to close above the Kijun, but then now the 20 EMA for the first time is curling over. What's more interesting is if you look right here, is this is the first close below the 20 EMA since back here, which is April 22nd, which is quite a long time. So you're talking over 10 weeks. This thing has not closed below the 20 EMA. On top of it, let's take it a little bit further. Assuming we close in the relative area of where we are now, let's say, somewhere below 162.5. Well, the bottom line is this will be the first close below the Kijun line, this red line right here, in how long? Long time, way back here. So you're talking actually March. So because the pattern has been pretty clear that the pair hasn't been able to close below the 20 MA and close below the Kijun, the fact that it is now, to me, becomes very, very significant. And so Paulie B has a good question. Do you focus on the candles more or the Ichi on a pattern like this for the breakdown? Both, actually. They kind of go hand in hand because the pattern on the candles, is in reference to the Ichimoku Cloud, particularly the Kijun. So in this case, it's both. What I'm really most concerned with is the pattern. What is the pattern, and is there a clear pattern? If there's a pattern, I'm interested. I pay more attention to it on the chart. If there's a very clear pattern, I become even more interested. Why is that? Well, if there's a clear pattern, then there's a clear mathematical approach to trading the market. And I can use that pattern to approach and attack and trade the market. And I can keep doing that until the pattern breaks down. If the pattern is still in play, probabilities suggest it's going to repeat. Patterns do that. They repeat until they break down. And so I will trade this until they break down. One of the patterns that I was trading for a while was touches off the 20 EMA. It's a very good pattern. Now that that's broken down, I'm going to trade the opposite of that. If the pattern was very consistently buying on touches of the 20 EMA and then that gets broken, well, then you're probably going to see a lot of people reversing positions or trying new positions or getting out of their longs. Therefore, you set up an environment where the opposite pattern is true, and therefore we want to be looking at now selling, at least in the short term, in my opinion, selling on touches of the 20 EMA and rejections of the 20 EMA. And look at exactly what happened today. Today's high was 62.95. The 20 EMA is clocking in at 63.17. So you're talking about roughly a 20-point difference. The thing came within 20 points of it. It opened at 62.84. It went up maybe 11 pips and then just sold off massively. So to me, now that the 20 EMA has been breached, it's kind of like the floodgates are open a lot now. They've opened up quite a bit here. So hopefully it answers your question. Ed has a question. Looks like little support according to the cloud on the way down. Absolutely. There really isn't any support on the cloud until here, which comes in at 59 and a quarter, 59 and a half roughly. Now, assuming that the next candle is quite aggressive, I don't expect I still don't expect it to find its way all the way down to the cloud here. If it does, then it's going to test this whole thing as support. Now, one thing that the pound US dollar's got going for it right now is the fact that the Kumo is quite thick and it's still climbing. So the fact that the Kumo is very, very thick and still climbing, all of this ultimately suggests that it's going to have a hard time breaking the support. It's going to have to work to make this thing, really break down further below the 59.35 region. So with that being the case, there is one last bastion of defense using the Ichimoku Cloud, and that is the Kumo right now. The Kumo is suggesting, hey, you know what? This thing's going to have to work. If by some chance it gets here, and then all of a sudden it dices through it in a very violent way, maybe 2 or 3 candles, then I think we're going to see a very quick attraction towards the 155 because we have this flat Kumo bottom here and it's a round number. And so with those two factors in play, if it starts to easily make its way through the top portion of the cloud, simply span A, then it could very well be attracted to the 155, and that could be quite a powerful move. A break below 155, say by the next week. In fact, let me look at the timing of this here. So right around July 15th, which is just shy of my birthday, just shy of July 15th is when we start to approach this black cloud. If we were to dump out the other side of it, we could see a massive meltdown in the pound-US dollar. So this has a lot of interesting potential to it. Right now, my bias is still, though, clearly to the downside, as it was last week. Okay, so Paul B was saying it would be a weak trade to sell to the Japanese because the cloud is rising. Yes, it would be a weak trade using traditional Ichimoku methods. That is absolutely true. However, there are still certain Ichimoku methods that I haven't quite revealed yet that I'm kind of saving for my book. And other than the Kumo, yeah, there are a lot of variables which would say, hey, the Japanese would still want to be buying. However, because of the fact that now we've had the closes below the Tenkin, the 20 MA, and the Kijun, the Japanese in some sense would become sellers, not necessarily adding new sell positions, but more so taking off their longs. So, you know, they would have been long throughout most, if not a good portion of this process. But now with this close below, assuming we close below the Kijun here, they would now become technically net sellers because of the fact that they would be paring back their positions. So that would actually kind of set up an environment that would actually support us taking shorts as well. So hopefully that answers your question there. All right, just having a good sip of tea there. Great questions. All right, fantastic. So does everybody feel pretty clear about what my approach is to this pair right now, how I'm using it in relationship to the Ichimoku Cloud, and where my general bias is? Does everybody feel like they understand that? Gustavo has a question here. The indicator is more of a guide. Price action tells us how the order flow is coming and what is it trying to do, correct? The indicator is a lot more than a guide, though. It actually gives you trade signals as well. It's both. It's designed to be both guide and actual system as well. So this isn't. You gotta understand, the Ichimoku Cloud is not just an indicator. If you look at it as an indicator, you're gonna miss the whole portion of the or you're gonna miss the real beauty and elegance of the Ichimoku Cloud. It is more than an indicator. It's actually a combination of several indicators. It's an entire method of trading. It's one of the few indicators out there that has, you know, multiple methods of giving signals. It actually has so many different components giving signals. There are very few indicators out there that have this many moving parts, this many components, that not only give signals individually, but they also have totally different functions. The Kumo is has a completely different function than the Tenkin. The Kijun has a completely different function in many ways than the Tenkin. And the same thing with the Chiku span. I don't use it, but the Chiku span, for the ones that do use it, has a completely different function than all of them. Very few indicators, if any. I really can't find an indicator out there where it has this many components and each one has so many different wide-ranging functions. It covers so many bases. So I would consider it more than a guide. But I'd also agree with your second statement that price action tells us where the order flow is coming and what it's trying to do. So I'm very much a fan of price action, and I would have to agree with that. As is the question, do Japanese traders using Ichimoku let superstition or use superstition when it comes to numbers to influence their trade decision? You know, I can't necessarily speak to that, you know, and I don't want to necessarily represent that. From what I do know of Japanese culture and Japanese or Asian traders as a whole, I wouldn't necessarily call it superstition. They're very into numbers, and a lot of the things that they have are actually very mathematical. Some of the like prayer beads and chanting beads that the Buddhist monks have, they actually have a specific set of numbers or a specific amount of beads, and it's based upon a base number and a variable. And that's because they believe there is a certain mathematical harmony and rhythm and energy to using that particular number or multiple of it. So I wouldn't call it superstition. They really try and employ mathematics into their trading as a whole. So I would call it a little bit differently than that. All right, so Jasper says, how do we enter a sell during this period of the day having your assumption? Well, since most of the information that I'm using and applying in terms of the Ichimoku chart and this pair is based upon the daily chart, then the answer to that is on the open or close of a candle. That's the first answer. In terms of a time reference, how do we enter a sell during this period of the day? I wouldn't be entering a sell during this period of the day. We're in the middle of a candle right now. I generally do not like to trade in the middle of candles because candles are not closed, they're not formed. So with that being said, I would wait for a close of this candle. If anything, I myself personally would actually rather wait till I got to another 20 EMA touch or rejection, because now I think it's going to act, in my opinion, as some sort of resistance. And if it's going to do that, and if this 20 EMA keeps falling and the Kijun comes to stays flat, well then when the 20 EMA and the Kijun meet, that to me might be a very good rejection point. As long as the oscillators continue to do what they're doing right now in the short term, which is declining, then I would be very apt to sell this on some sort of rejection play off the 20 EMA or the Kijun there. That would be my preferred strategy. Right now I feel like that's going to probably end up being the one that plays itself out. The other thing you also want to look at is, remember, 62 was a really good rejection area for a while. Therefore, if the pair falls a little bit further, so is the 20 EMA, and they will come in right around that 62 region there. So to me, this is that's my preferred play. Frank has a question. Why no Chinkoi span? It's actually Chinku span. Why no Chinku span? Because the Chinku span visually I think is unnecessary. I can get the information that the Chiku span offers just by looking at the chart. Remember, the Chiku span is really a line that mirrors perfectly price action, but it's just shot 26 time periods back. And it's designed to be an additional signal to kind of cue you into whether the line of least resistance is to the upside or the downside. I can see that visually. I don't need an extra line on my chart to do that. So since it's unnecessary, I remove it. And very much like they say in the Tao Te Ching, or there's actually a famous Taoist saying. It's not in the Tao Te Ching. It's a famous Taoist saying which says, when the sculptor is trying to build a piece of art, he's not adding contents to the stone. He is simply removing the unnecessities. And that's exactly what I'm doing, is I'm removing all the unnecessities from the chart so that I can have a thing out there that really reveals the actual sculpture that's being molded by price action. So there's my little Taoist saying for the day. Hopefully you all feel enlightened from that. Abel's saying, could you briefly let me know what the idea for the pound US dollar pair you just joined? Sure. I'll repeat that just for everybody. So my belief and my analysis is suggesting that, at least right now, that this pair is likely going to continue to fall further. That is, a combination of the pattern of the 20 EMA no longer offering itself as support breaking down. Same thing with the Kijun. Same thing with the 20 EMA curling over. And so because of that, because it's been a long time since we've really closed below the Kijun, which I think we're going to do today, I think these are going to now act as some sort of resistance. So I'm looking for rejections off of the 20 EMA and the Kijun. If everything still supports it, the oscillators still look good at the time when that happens next, then I'm going to, consult my intraday time frames to confirm, and then I'll, most likely be taking the trade. But this is one I'm very interested in. And I have been interested in since last week, and y'all know that, because I was suggesting this is going to fall and suggesting that we were going to probably get some very good play off this. Okay, Abel's saying, but the signal is above the cloud. Isn't that considered a weak signal? It's considered a weak signal if you're trading the Tenkan Kijun cross as your method. But if you're not trading the Tenkan Kijun cross as your method, then it wouldn't necessarily be a weak signal because I'm not using that as my method. So the answer is, if I was using the Tenkan Kijun Cross, the answer is yes, but I'm not using that. Gustavo has another question. Do you look for price action in the lower time frames to align your opinion of the daily as well as target support in the daily? Also, do you place your stop behind a major resistance or simply set a number of pips? Okay, let's answer those two questions individually. Question one, do I look for price action in the lower time frames to align my opinion on the daily? When I'm going to take the trade, if the trade is based upon the daily charts, then what I'm most concerned with is how the daily chart is looking at that time period. This is my frame of reference. This is the time frame that I'm basing my signal on. Since it's the time frame I'm basing my signal on, I'm most concerned with the daily chart. I could take this trade without consulting the lower time frames. However, it could be very beneficial if I do check out a smaller time frame and I find out that that smaller time frame really confirms it. You know, what time frames would I want to consult? I probably want to consult the 4-hour and say the 30-minute. The 30-minute would be more of, if I wanted to, the 30-minute would be more to time the trade, but I may not need to time the trade because I may be looking mostly for price. It might not have anything to do with the timing. It may just be, hey, I want to get in at this price. And I can derive a good portion of that information based upon the daily chart. So it's not necessarily that I look for price action in the lower time frames to align with my opinion in the daily. Sometimes yes, but sometimes I just want to get in at this particular price because at this particular price is where I feel the risk to reward would be balanced. It wouldn't necessarily be that important if I get it in the next hour or in 10 hours from now. As long as my time frame right now still supports that trade and all the variables that I'm using to make that trade decision still support it, then I kind of look at it as like I have a very clear verdict from the jury. The smaller time frames would just be a little bit icing on the cake, and it wouldn't necessarily be necessary. Your second question is also, do you place stops behind a major resistance or simply set it a number of pips? I never set a stop a simple number of pips. I never do that. Stops, just like limits, just like entries, just like exits, should always be based upon some sort of support or resistance or something that is referencing or acting as support or resistance. I would never just randomly pick a number of pips and apply that to my stop. I think that's a very risky method in terms of trading. I would consider that almost a junior way to trade. The only way I would do it a set number of pips is if I could demonstrate mathematically that would be a very good, number or variable to set my stop. Otherwise, I would never arbitrarily set it anything. I don't want to have anything arbitrary in my trading. I want precision. And the only way I can get something precise is if I have very specific information. So hopefully that answers your question. Paul B says, when price action is trending strongly, is the price always far away from the cloud? The answer to that is yes. When price action is trending strongly, it is always going to be very far away from the crowd. If it's a medium to mild trend, it'll be a little bit closer. But a strong trend will always gain distance from the cloud. And so the distance from the cloud suggests the level of volume and volatility involved in that. That's why actually, if you are an options trader, trading the Ichimoku Cloud is actually very, very powerful because the part of options trading is the overall levels of volatility. And so, understanding volatility. And so I actually was working with an options trader last week, and we had an awesome session because I was able to show him many of the Ichimoku techniques and how he could use that for options traders. Very powerful technique. Option traders should be learning this hands down. So hopefully that answers your question there, probably. Wolf has a question. Good to have you here, Wolf. If you were long on this trade, would I go out now? At this point, I would. I wouldn't wait for a Tenkan and Kijun cross to the downside because that can be a little bit late to the party. The other reason why I would is because the pattern has been so clear with the 20 MA and the Kijun that now that pattern is violated, I would be out of the position at this point. I would have taken profit. And then if I was, going to take another long, I would look for another optimal environment to do that. And I don't think we have that quite yet. Ed has a good question here. What is your minimum risk-to-reward ratio? I don't have a minimum risk-to-reward ratio because I don't look at risk-to-reward ratio as a two-dimensional mathematical formula. I look at it three-dimensionally. To have fixed minimum risk-to-reward ratio would only be useful if I was trading one system. But the thing about it is that risk-to-reward ratio is meaningless if you do not have a general gauge of your overall accuracy. It's absolutely meaningless. On face value, somebody trading with a 4-to-1 R-to-R, reward to risk ratio, should be someone you would think, if somebody's trading with that consistently, they make money. But they may only be accurate 9% of the time. So on face value, 4-to-1 R-to-R sounds, nice and rosy. It sounds great. But it's completely meaningless absent from the accuracy of your system. So, the bottom line is that I never look at risk to reward two-dimensionally. I always look at it three-dimensionally. So I think it's good as a beginner method to say, hey, you generally want to, try and use 2-to-1 or 3-to-1 R-to-R. But ultimately, I would consider that sort of mentality and approach. I would consider that more of like applying training wheels to somebody learning to ride a bicycle. I would consider that the third or the fourth wheel, so to say. Those little wheels that you put on the side of the bike so that the person riding the bike doesn't fall over. So that's what I would consider staple risk-to-reward ratios. Eventually, you want to get to a place where you can understand your overall level of accuracy per system or method that you're using. It doesn't matter what your level of accuracy is, whether it's 30% or 80%, it doesn't matter. Once you get a pretty good read on the level of accuracy you're using for each individual system you're using, then you can start to apply risk-to-reward ratios to it properly because you'll have a good gauge. The other thing about it is that part of you building your system should be understanding. It should automatically have implemented in it, first thing, the level of accuracy you can expect from this on any given day over a long period of time. Second, what you would need to consistently make money on that thing. There's actually one system out there that I was reviewing recently. The guy was touting 86% accuracy. And so anybody that touts that kind of accuracy and has a good track record, I'm very interested in looking at. However, upon further review, when I looked under the hood, I discovered that there were, there were some really, really delicate things that it was almost like the system was built upon a very fragile house of cards. The reason why he was able to do 86% accuracy is because whatever his target was, he was taking his stop and multiplying it times 3 times the target. So if his target was 50 pips, his stop was 150 pips. Invariably, I got a few minutes left. I'm going to wrap it up here. So, to cover this last component here, he was taking his target and always multiplying it times 3. And yes, he's able to trade 86% accuracy right now, but there's an inherent problem with the system. Anytime you're building a system, you have to build it under the contingency that it's going to have an environment where it's going to fail. If and when that thing fails, and you continue trading as is it going to destroy your account? And the thing is, with a 3-to-1 risk to reward or 1-to-3 reward to risk ratio, when his system fails, he is going to have a gigantic drawdown. So I actually, in reviewing that system and staying away from it, because I know systems eventually fail. They may not fail permanently, but they're going to have a failing environment. And when they do, can you sustain the risk? I only take on systems where if they fail, that I'm comfortable with the risk. I can feel like, okay, yeah, this thing is not working right now, and it's okay because we're not losing that much money. But to have 15, 20, 30, 50% drawdowns, to me, would not be worth it to have 5 or 6 months of good profitability. Because when the thing loses, it's going to lose huge. he actually had one trade where he had a 717 pip stop. Anybody can be 86% accurate with a 717 pip stop. So when you look under the hood, there's rotting corpses underneath. I got time for about 2 more questions, and then I got to wrap this up here. So, okay, so hopefully I answered your question, Ed. Gustavo Lopez says, what is your risk you take per trade? 2% as a constant, or do you base it on the trade individual? The staple method that I use for risk is 2%. If I really feel that something is kind of an absolute cherry, like last month on my personal trading account, you're going to laugh, I traded 3 times. I won every single trade, and I walked away with net 11% accuracy, or net 11% profit. I'm happy with trading 30 times or 3 times. And so last month, I didn't like the environment too much. So personally, I only took the cherries. And as I traded and this is on my own personal individual account, I only traded the cherries. And because of that, I was able to do really well. Now, a couple of those trades, I increased my risk to 5% because they were cherries. But the bottom line is that it depends on the type of trade. If it's your general, trading signal that I have and it's not standing out as some extraordinary signal, then 2% is what I like to keep it at. If it's something that's really screaming at me, it's something like, wow, this is going to happen, then I'll put on 5%. To me, it's worth it at that point. Abel's question is not quite the focus of this class, so I want to wait. I'd like to address that in a different class. So let me see if there are any other questions here that are referencing this. Ed has one good question I think everybody can benefit from, and I want to answer this and I want to wrap it up if that's okay with FX Street. So Ed has a question. What are you doing reference to the new NFA FIFO rule? What can a novice trader do apart from find a new broker to trade offshore? To be honest, I would do that. I would move your money to the UK. There's plenty. If you're trading with a large broker, more than likely they have a UK branch where you can do it. I would rather just do it. In fact, to be honest, in regards to regulation, I am going to move, all of my capital out of the US because I don't think the US understands how to regulate Forex. The European traders, they've been doing this for a long time. They understand this. They have all the regulations in place. The bottom line is they have no problem in terms of relating to currencies. But because there's a combination of what's happening right now, you have a very panicked government regulatory body right now that's kind of under the gun to increase a lot of regulation. The thing is, they don't understand this market. They're newbies in it. They've only started putting regulation on it into the last, 8 or 10 years. The Europeans have been trading currencies for over 1,000 years. They understand this market inside and out. So me personally, I don't want to be in an environment where the regulators don't have a clue as to how to relate to this. So because of that, I think that this is actually a very bad move by the NFA. They're trying to treat currencies spot for futures trading, and it's not. It's a very different entity. It's a different animal. It would be like comparing NASCAR to Formula One racing. You need a different type of driver. You need a different type of car. They just don't relate. And if the NFA really had any sort of intelligence, I think they would start looking at the European models as to how to regulate, how to relate to it, because they understand how to play this. The NFA really just doesn't have a clue. And remember, the NFA only makes money by finding companies. That's how they make their revenue. If they don't find companies, they don't make money. They're in trouble. So, just a little insight to the NFA. I've actually worked side by side to them when they came into our office. So, I just don't think they really understand what's going on. Equities, I think they have a pretty good idea what's going on. But even then, the Madoff thing and all that really represents how they don't necessarily understand it. So, bottom line, I would just move your capital offshore to a UK broker. I think you'll do just fine with that. Okay, so why didn't the FX brokers resist? Because they can't. They're under the regulatory body of the NFA. There's nothing they can really do. And trust me, they did protest. I know the CEOs were protesting up and down, and the bottom line is that they just don't have that kind of clout with the NFA. They're not that big yet. If they had hundreds of billions of dollars, maybe. Maybe they could do Citibank or AIG kind of thing. But other than that, just move it. And the funny thing is, all this money is going to leave the U.S. and then the U.S. is going to lose from this. So anyways, that's it. I got to wrap up. FX Street is got to be, waiting for me to get off here. There's another class happening after, so stay on for the next class. I want to thank you all for coming. Let's go down the list. Forex Bob, Jocelyn MC, Pete Eds, John Milstrat, Anthony R. Lance, B. Milch, Jasper, Mike, Kurt, Burns of UK, Jim Hader, Zamal FX, Tom D. Zool, Wolf, good to have you here, Paulie B, Frank Harley, Carla, Forex Champion, Tomcat, Derek Nazak, Engine, JM Cat, Jacqueline, Kitwell, Netstar, Pip Rider, Kim Abel, Linda, Fred, Jeff S, Titus, Solby, Splog, Gustavo, Viv, Rista, Charlie W, NX Tree, or something like that, FXG, and John from George. Thank you all very much for coming. It was great having you all here. If you have any questions about my services, what I do, www.tunedskies.com. Go ahead and check out the new site. And if you have further questions about our services, private mentoring, trade signals, anything, feel free to contact me at info@tunedskies.com. I'd love to hear from you. Until then, I'll see you next week. Good hunting, everyone, and take care.